Equity investments play a fundamental role in portfolio construction because they serve as a primary source of long-term wealth creation. The most important contribution of equities is capital appreciation, which results from growth in a company's earnings, revenues, cash flows, and overall business value. Historically, equities have generated higher returns than bonds and cash equivalents over long investment horizons, compensating investors for accepting greater risk and volatility. During periods of economic expansion, corporate profitability generally increases, supporting rising equity prices. Consequently, investors seeking long-term growth objectives often allocate a significant portion of their portfolios to equities. The allocation decision must remain consistent with the investor's return objectives, risk tolerance, liquidity needs, and investment horizon. A second major role of equities is the generation of dividend income. Many mature and financially stable companies distribute a portion of their earnings to shareholders through regular dividend payments. Dividend income provides a recurring cash flow stream that can support spending requirements, retirement needs, or reinvestment strategies. Although dividend payments are not guaranteed and may fluctuate with corporate performance, they often represent a significant component of total equity return. Dividend yields tend to be more stable than capital gains because they are less sensitive to short-term market sentiment. For investors focused on income generation, dividend-paying equities can provide an attractive balance between current income and future growth potential, enhancing the overall effectiveness of a diversified investment portfolio. Equities also contribute valuable diversification benefits within multi-asset portfolios. Diversification arises because equity returns are not perfectly correlated with returns from other asset classes such as fixed income, real estate, commodities, or alternative investments. By combining assets with different risk and return characteristics, investors can potentially reduce overall portfolio volatility without proportionately sacrificing expected return. Modern portfolio theory emphasizes that diversification improves risk-adjusted performance through the interaction of asset correlations. While equities themselves can experience significant fluctuations, their inclusion alongside other investments often improves portfolio efficiency. However, investors must recognize that diversification benefits may decline during periods of financial stress, when correlations among asset classes tend to increase and market volatility rises simultaneously. Another important function of equities is their potential role as a hedge against inflation. Inflation erodes purchasing power and can negatively affect the real value of fixed cash flows. Equities may provide protection because companies can often pass rising input costs to customers through higher product prices, thereby preserving profitability and supporting earnings growth. Certain sectors, such as energy, materials, infrastructure, and consumer staples, may be particularly effective during inflationary environments. As corporate revenues and earnings increase alongside general price levels, stock valuations may adjust upward over time. Although equities do not provide a perfect inflation hedge in every economic environment, they generally offer better long-term protection against inflation than fixed income securities with predetermined cash flows. The appropriate allocation to equities depends on each investor's unique objectives and constraints. Portfolio managers evaluate factors such as required return, risk tolerance, liquidity requirements, tax considerations, and investment horizon when determining equity exposure. Investors with longer time horizons and greater risk capacity typically allocate more heavily to equities because they can withstand short-term volatility in pursuit of higher expected returns. In contrast, investors requiring stable income or near-term liquidity may maintain lower equity allocations. Environmental, social, and governance (ESG) preferences also influence equity portfolio construction. Managers may apply positive screening, negative screening, thematic investing, or impact investing approaches to ensure that selected investments align with client values while still supporting financial objectives. From a portfolio management perspective, equities represent a versatile asset class capable of fulfilling multiple strategic functions simultaneously. They provide growth through capital appreciation, income through dividends, diversification benefits across asset classes, and potential inflation protection. These characteristics explain why equities remain a core component of most institutional and individual investment portfolios. Effective equity allocation requires balancing expected returns against associated risks while considering investor-specific circumstances and constraints. Successful portfolio managers integrate equity exposure within a broader asset allocation framework that aligns with investment policy objectives and long-term financial goals. Understanding the various roles of equities enables investment professionals to construct portfolios that optimize risk-adjusted returns while meeting the evolving needs of diverse investors.